Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, 2017 and 2018 fund data. Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Jim, thanks for having me back, and thank you to everyone tuning in.
Ted, what's topping the Insider Inc. Index Top 40?
Well, we're seeing a busload of opportunities, as we wrote to our subscribers in our November Top 40 report, and that's available to Inc. subscribers and Canadian Insider Club members off of CanadianInsider.com, and you can also buy it if you're interested in as just a single report. But the very interesting development that we've seen this month is, the breadth of opportunity that's coming up in the Canadian market. When we look at our top 40, and these are basically the top 40 stocks that are preferred by insiders. We rank them every month based off of a quantitative process. It's not Ted and his business partners sitting around picking which stocks we like. We have a quantitative filtering system that decides the rankings, and it's pretty interesting. We've got some clean energy vehicle companies that are listed in Canada in the list. We've got some mining companies, although most of them are tilted towards the industrial miners. We of course still have some gold miners in there, and we have some consumer companies. So it's a real broad range of economy-sensitive companies, and I think why it's really interesting that we're seeing this broad reach of opportunity here in the market, and it's sort of not loaded up just with gold. It's never been just loaded up with gold stocks, but a few months ago, gold and utilities were really the standout areas that were hitting our screens. But the nice thing about seeing sort of a diversity of opportunity is it gives us more confidence that the what we call the Canadian Insider bull market is off to the races here. And not a lot of people are talking about the big moves we've had in Canadian stocks because it's been overshadowed, of course, by the mainstream media, where all they want to talk about is Apple and Amazon and Facebook. But actually, our Canadian Insider Index, which tracks the 50 most preferred stocks that are eligible for institutional investors, that are big enough that the institutions can actually buy them, where our top 40 it is covers smaller stocks as well. But our Canadian Insider Index, it is actually, since inflation expectations bottomed on March 19th, is outperformed the NASDAQ QQQ, yes, with Amazon and Facebook and Netflix and Microsoft, all those darlings that we hear about nonstop, particularly on one American television station. The Canadian Insider Index is actually has outperformed the QQQs by about 5% since that date, and that's before the currency. Throw the currency in, it's add another 10% on top of that. So there has been a stealth move here in Canadian stocks, stocks that insiders like, and seeing the breadth of opportunity in our reports gives us some confidence that this bull market's going to continue.
What's driving it? You said it's a wide variety of things. Is it Canadian innovation as we try to move into what they call a new economy?
That's part of it. And part of it is just old-fashioned insiders signaling that inflation is coming, which means that even in some of the more traditional areas, such as mining, industrial mining in particular, that revenues will be going up. There will be nominal revenues for sure, but insiders, like it when their businesses are growing, right? When the top lines are growing. So we're seeing a lot of confirmation that down the road over the next 6 to 18 months, and that's usually the time frame that I'm talking about on this show. Everyone has to look at their own time frame. Everyone has different time frames, but usually I'm talking about 6 to 12 month time frames here. That things are looking up. Is it a guarantee? Of course not. Right? There are plenty of risks down the road. Right around the corner. But on balance, the fundamentals are shaping up pretty good. We're seeing that in higher bond yields that are signaling some better times ahead, and the Canadian market at this stage is looking pretty good to us, particularly those stocks that insiders like.
We'll have more with Ted Dixon right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Ted Dixon. Ted, in the past, you've talked about a D versus G economy. Could you maybe explain that and then tell us where do you think we're going?
That's a great question, because the D versus G is a framework that we launched basically early last spring or late last winter in terms of how we're going to look at the environment going forward. Remember, this was right when everything was falling apart in terms of the market. COVID was hitting. Said, okay, look, how are we going to look at things in terms of what assets are going to do well and what assets are going to do poorly coming out of this? And we suggested there's either going to be a D economy, which is deflation, debt-riddled economy, which would likely unfold if policymakers just tried to do the same old thing that they did after the great financial crisis, which was basically give money to the big corporations and the big banks, and that's it. If that's what they did, we thought, no, that's going to be a disaster, and we're going to have a D economy. But if policymakers start giving money to people, start spending, if governments start spending more money, more than they ever have before. Yes, I know governments always spend money, but our view was there's a chance that governments would even spend more money than expected. Then you could have an inflation-driven economy, the G economy, government-led inflation. You say, well, Ted, where's the better scenario where, everything works out and governments don't get involved and everything kind of resets to a new normal that's upbeat. And unfortunately, we don't see that happening yet. Although, maybe that's a discussion for another day. There are some positive developments are happening through, that seem to be coming together. But back in the spring, we said, look, it's either going to be deflation or it's going to be a government-led inflation. And as things have turned out, up until today, the G economy is winning. That is why you're seeing insider stocks do so well, because our Canadian Insider Index has a very high correlation with rising inflation expectations. So that's why under a G economy, you want to have some exposure or a good dose of exposure to Canadian stocks, and I would, suggest stocks that insiders like. So that's the way things are unfolding. Are there risks that we could flip into a D economy? There are plenty of people that build a very articulate case for why everything's going to fall apart here and why there could be, another downturn. And so, sure, there's always that risk, but there's also, the likelihood that markets are going to correct along the way, which would be normal. But you have to decide, okay, is this a healthy correction? Although, is there such a thing as a healthy correction, depending on, if you're long? But is it a normal correction, or is it something worse? Are we going into the D economy? And that's why our D versus G framework continues to be something we look at. It remains something that we monitor all the time. Right now, G is winning. I'm sorry to the deflationists. You're wrong. You've been wrong so far. The ball is in your court to prove otherwise. The bears have blown it, in terms of continuing to warn since March of disaster. And things could turn around, sure, but we don't see it yet. Could it change? Sure, it could change, But right now, the proof is in the court of the bears. But we're watching, and we will switch if we see that credit spreads are starting to widen, that the insiders are starting to take massive selling, based off of the recent run they've had. So sure, we have our eyes wide open, and we're not married to a view. That's why we have our G versus D economy. But it's also incumbent upon the bears to have some flexibility as well, and to admit when things have changed. And we have seen some deflationists throw in the towel. Russell Napier, who's been, for example, he was on Ink Ultra Money just in the last week, explaining how he's gone from a deflationist to an inflationist. He thinks there's going to be a big move in inflation here, and we would agree with that. And we've seen that since March 19th. Inflation expectations have bottomed. They've been moving up. Yes, they're consolidating here. Yes, they've stopped. But to me, that's a buying opportunity, and that they're consolidating here. Around the 1.8, 1.7% level. And when what I'm talking about are inflation expectations as measured by break-even yields on Treasury bonds, which is sort of the implied inflation rate that you can get from the difference between the regular bond market and the inflation-protected bond market. Those expectations have leveled off. So you either believe that these inflation is going to stick where it is, and if that's the case, well, then we probably aren't into such an exciting period for any further, for Canadian stocks. It could be okay. But where we would really get the bump is if we get another leg higher in inflation expectations. And, we've got the Fed committed to now shooting higher than 2%, shooting above that. And if you're saying, no, we're headed for deflation and all the wheels are going to fall off, then you're betting that the Fed is not going to do everything it can to meet its objectives and not be successful at it. So, yeah, there is a chance that will happen. But it is a fiat money system. The central banks run the fiat money system. If they really get committed to flooding the system with money that's going to push up the inflation rate, they can probably do it. Now, they'll have to do it, I believe, in conjunction with the fiscal authorities, such as the U.S. Treasury. In Canada, they have to do it with the finance department. In the big difference between now and 10 years ago was that central banks thought they were an island unto themselves and they could solve everything and they could do it all. Well, we found that what they can do is they can really widen the wealth gap, and they can make the rich a lot richer. But they can't really make this 2% inflation target thing work for the average person. I don't think it ever does work for the average person or anyone in the long run, but their policies in the past decade did one thing for sure: they made the rich richer and the poor poorer. Okay, so they don't want to repeat that. If anything, I guess they'll want to make everyone poorer, but not have such a wealth gap. When I mean poor, I mean, of course, have everyone's purchasing power eroded away, as opposed to just having the poorest in society being screwed, which is really what their policies did in the past 10 years. So, I think they begrudgingly, have realized that this is not a good idea, and that's why you've got people like Jerome Powell going to Capitol Hill in the U.S. begging policymakers there to spend more money, to go deeper in debt in terms of in the U.S. government, because they know that if it's left to the central bank to do it all, sure, they'll do it, But guess who's going to win? It's going to be the top 1%. And what kind of problems is that going to have down the road? I think the central banks have figured that one out.
We'll have more with Ted Dixon right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, are people who are invested in things involved in home renovations doing well right now?
Well, we've seen those stocks do relatively well, and it's been one of the top gainers. So yeah, it's been a good place to be. That was an early winner because when the Fed and the central banks around the world and in Canada here lowered rates and took action, the housing area was the first to benefit, and they had the extra sort of oomph that people were at home and either in lockdown or working from home. So it was kind of a natural that if you'd been waiting to do something for your house and fix it up, and you were at home, you had extra time because you weren't commuting every day, and maybe the government was giving you a bit of a subsidy, and if you weren't working, maybe you thought you'd be working again. Well, I'm going to fix up the house, and if worse comes to worse, I have to sell the house. I might as well at least fix it up. So it was a big shot in the arm for that group. I think probably going forward, there are other groups that may stand to benefit, and particularly with the potential arrival of a vaccine. I know it's been talked about a lot. I'm not going to talk about it too much because we'll see how it all unfolds. But there are some clear sectors of the economy that would benefit from that, and that's another reason why we've seen the Canadian Insider Index move up, and why our top 40 stocks. The stocks in our top 40 have broadened out because there's going to be more opportunity, I think, in 2021. And, just getting back onto sort of is there another scenario where things could look a lot better than just this D scenario and this G scenario? I think there is. I think there's sort of an emerging I scenario for improvisation and innovation where I think a lot of companies, a lot of people have learned to innovate quicker, improvise, and new business models have been formed. So combine that with a lot of people who are still sitting on cash from saving money this year, not having as many expenses, not going on trips. As there's a lot of money, I think, to be spent on the sidelines. Yes, there's a lot of debt. I know we hear all about that. But we also heard a very compelling story on In Culture Money last week that yes, there's a lot of debt going on in the world, but there's also been a lot of liquidity that's flown into the world too by governments and central banks, and that is going to help offset a lot of the debt that's in the economy. So, let's not be too pessimistic here about where we've been. It has been challenging, and but 2021 is shaping up potentially to be a lot better, but we will still, of course, have to see how some of these risks play out. And I just want to let you know, in terms of the fellow who was talking about that sort of increased savings rate. There's been a few people in the market that have been doing that, but the person we had on, I believe his name was, I'm just trying to pull it up here, but there we go. Michael Howell of Cross Border Capital. That was one of his themes that he was talking about, and there have been a few others that are mentioning that. I believe there's a report also from CIBC in Canada out talking about that. So there are potential springboards for 2021, but of course there are also some big risks out there too, and we should probably cover some of those off as well.
One of Canada's big concerns every year is the high cost of imported fresh food. will some of those empty condos, especially in places like Toronto, be converted into vertical farms so we don't have to send out for food? We could grow it right here.
I don't know. That's an interesting idea. I know there is a company that we've written about in our reports that are looking at providing technology for farms, like old-fashioned farms, like local farms, where they can improve their productivity and allow them to compete more with some of those those farms in other jurisdictions that may have an advantage, climate advantage because of the climates. So there are continual innovations happening in agriculture. I hadn't heard that about the empty condos, but you never know, right? I mean, this is the whole exciting part coming out of this pandemic. There are a lot of innovations and improvisations that are happening that you would never have thought of. So that is why I'm quite excited about 2021. If for no other reason, it looks like there will be a vaccine at some point. But the whole psychological shift that's happened during this pandemic, I think there is a huge pent up amount of creativity and innovation that's been building, and this is about to be unleashed in 2021, and we're already seeing some signs of it. So it's it could be an exciting time. We could have quite a good 2021, Jim. But politics could always get in the way, and there are risks out there. I don't want to make it sound like it's a slam dunk. There are definite risks, and I think that one of the biggest risks is that the political situation in the U.S. If we have a gridlocked Congress, then they may not get through the type of stimulus that is probably needed to see the U.S. economy through the rough patch here that's remaining, and who knows what that's going to do, for markets. We've got the bulls, myself included. We're out there skating, but we don't know how thick the ice is, and it's we're trying to keep measuring it and get a sense of how thick it is. But if the U.S. political situation heats up, that ice could melt away, and that would not be good for markets.
How Canadian to think about how thick the ice is. Ted, thank you so much for chatting with us.
Jim, thanks for having me back.
My guest has been Ted Dixon, CEO and co-founder of inkresearch.ca, his website, CanadianInsider.com. If you have any questions for Ted or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.